The Reserve Bank of India (RBI) monetary policy meeting held on 6 June 2025 led to a cut in bank repo rates by 50 basis point (BPS), bringing the rate to 5.50% from 6%. RBI also cut cash reserve ratio (CRR) by 100 bps from 4% to 3% on deposits in 4 tranches of 25 bps each. RBI decisions resulted from retail inflation cooling to 3.16% in April. Union Bank of India's report estimates the retail inflation to drop to a 6-year low of 3%. CRR cut will release primary liquidity of rupees 2.5 lakh crores or $29.4 billion. Reserve Bank of India Governor Sanjay Malhotra said Consumer Price Index (CPI) inflation is revised down to 3.7% from earlier 4%. Near-term medium-term outlook gives confidence on durable alignment with 4% target. Growth estimate for FY 2025 is at 6.5% and in FY 2026 growth will remain strong. Gross foreign direct investment (FDI) increased 14% in FY 2025. Forex reserves stood at $691.5 billion. Both by inflation growth markers, Indian economy is progressing well, said RBI Governor. In his speech, RBI Governor said,
Good morning and namaskar. The 55th meeting of the Monetary Policy Committee was held in the backdrop of an early and promising start of the monsoon season. This is of vital significance for the Indian economy. In contrast, the global backdrop remains fragile and highly fluid. The uncertainty around the global economic outlook has somewhat ebbed since the MPC met in April in the wake of temporary tariff relief and the optimism around trade negotiations. However, it is still high to weaken sentiments and lower global growth prospects. Accordingly, global growth as well as trade projections have been revised downwards by multilateral agencies. Moreover, the last mile of disinflation is turning out to be a little more protracted. As growth-inflation trade-offs is becoming more challenging, monetary authorities are charting out a more cautious and carefully calibrated policy trajectory. Looking beyond the near term, growing economic and financial fragmentation is reshaping the global economy. Besides complex interconnections with the financial system, elevated debt levels, and growing influence of frontier technologies like AI are raising financial stability concerns. Amidst heightened volatility in capital flows and exchange rates, coupled with constrained policy space, central banks of emerging market economies have a tougher task to stabilize their economies against global spillovers. In this global milieu, the Indian economy presents a picture of strength, stability, and opportunity. First, strength comes from the strong balance sheets of the 5 major sectors: corporates, banks, households, government, and the external sector. Second, there is stability on all 3 fronts: price, financial, and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through 3 Ds: demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5 by 3 by 3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace. We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047. I now come to the Monetary Policy Committee decisions. The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%. I repeat, the reduction recommended by the MPC is for 50 basis points to 5.5%. This is with immediate effect. Consequently, the standing deposit facility rate, which is the STF rate, shall stand adjusted to 5.25%. And the marginal standing facility MSF rate and the bank rate shall stand adjusted to 5.75%. I shall now briefly set out the rationale for these decisions. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. Latest numbers are 3.2%, with signs of a broad-based moderation.